A liquidity trading strategy focuses on identifying key areas of liquidity in the market where institutional players, like banks and hedge funds, are likely to execute their orders. These areas are typically zones with significant pending buy or sell orders, such as support and resistance levels, order blocks, or stop-loss zones. Here's a comprehensive guide to a liquidity-based trading strategy. First, understand liquidity zones. Liquidity zones are areas where many traders place stop-loss or pending orders. Price often moves to these zones before reversing, as large players hunt this liquidity to fill their own orders. Key areas to watch include swing highs and lows, where stops are placed by retail traders, order blocks, which are areas of consolidation before a strong price move, and psychological levels, like round numbers such as 10,000 or 15,500 in indices. Next, market structure. Liquidity trading relies on reading market structure. In a bullish market, you'll see higher highs and higher lows. In a bearish market, you'll notice lower highs and lower lows. For trend shifts, look for breaks of structure or BOS when a trend reverses. Now the strategy. Step 1. Identify liquidity pools. Spot stop-loss clusters above recent highs or below recent lows. Look for imbalances or fair value gaps known as FVGs, created by fast price movements. Step 2. Wait for a liquidity grab, also known as a stop hunt. This is when the price moves into the liquidity pool, triggering stop losses or filling pending orders. Observe whether the price quickly rejects this level. Step 3. Confirmation entry. After the liquidity grab, look for a break of structure or BOS on lower timeframes. Enter the trade in the direction of the rejection. Place your stop loss above or below the liquidity grab. Step 4. Set targets. Target the next liquidity pool, such as swing highs, lows, or order blocks. Use a reward-to-risk ratio of at least 1:2 or 1:3. Alright, let's dive into the tools for liquidity trading. First up, we have ICT concepts. You'll want to use institutional order flow and concepts like fair value gaps, often referred to as FVG, and premium or discount zones. Next, there's the volume profile. This helps you identify areas of high volume, known as the point of control, where institutions are actively trading. And finally, don't forget about candlestick patterns. Keep an eye out for strong rejection candles, such as pin bars or engulfing candles, especially at liquidity zones. Risk management is crucial. Here are some key points to keep in mind. Risk only 1 to 2% of your capital per trade. Always use a tight stop loss just above or below the liquidity grab, and avoid over-leveraging, as liquidity grabs can lead to whipsaws. Now let's walk through an example trade workflow. First, identify the zone. Spot liquidity above a swing high or below a swing low. Next, wait for the price to sweep the zone and reject. Then, look for a break of structure and a retest on lower time frames for confirmation. After that, enter the trade after you see the rejection confirmation. Finally, manage the trade by targeting the next liquidity pool or imbalance zone. Here are some key tips to keep in mind. Be patient and wait for the liquidity grab to happen. Avoid trading in the middle of the range. Instead, focus on the edges where liquidity lies. Also, combine your strategy with time-based confluences, like market opens, for example, the London or New York Open. Now let's look at an example of a bullish setup. First, the price sweeps a swing low, indicating a liquidity grab. Then, you see a strong rejection with a bullish engulfing candle. On a lower time frame, you observe a break of structure to the upside. At this point, enter long after a retrace, targeting the next swing high. Thanks for watching. Please like and subscribe to the Begin Trade channel. Check the link in the description below to open a trading account.